Today I'm going to be talking about a concept that I think is absolutely invaluable for any trader. I personally have been trading for over 2 years now, and whenever I first learned about this concept, it vastly opened me up to many opportunities that I was previously ignoring in the market. And this all stems from the fact that a lot of people are afraid of trading heavily trending markets. However, in this video, I'm going to explain to you why you should in fact be trading trending markets and how to effectively take advantage of them and understand what's happening in the market whenever a market is heavily trending so that you can trade them safely and profitably. Now, before I get into the video, make sure to like and subscribe if you'd like to see more content like this. Also, make sure to join my Discord group down in the description down below if you'd like to join our amazing community of like-minded traders who trade stocks, cryptocurrency, and Forex every single day. But without further ado, let's get right into the video, first talking about something that might seem a little bit confusing. However, I assure you it connects to this concept of trading heavily trending markets. So the first thing that I want to talk about in this video is having the basic understanding of who you're competing against in the financial markets. I think if you look at other industries such as technology or basically literally any other industry in the entire world, you'll see that those industries are very focused on identifying and beating your competition. If you're Apple, you're looking at every single other phone company and making sure that you always have the best product out there, and at least you're trying to understand your competition so that you can always be one step ahead of them. And I think this is a huge flaw with a lot of traders, even some people that I've seen trading for, multiple years on end, and they're still not doing this. And that is analyzing your competition in order to better understand what's happening within the financial markets. And this applies for cryptocurrency and stocks. However, it does not apply for Forex, as that is one market that is an exception. So let me first talk about who your competition is in these markets. Obviously, in these markets, you are trading against someone else who is also trying to trade against you and profit off of the markets. And whenever you look at competing traders who are trying to profit off of the market, who's the biggest competition? Who's the most important person that you should be looking at? Well, that is hedge funds. So let's say we have hedge fund A, which controls a large pool of money. And then we also have hedge fund B, and they decide to have two different trading strategies within this heavily trending stock market period. And let's say they both started at the same time, right after the market crashed from the 2008-2009 financial crisis, and they are trying to decide on strategies to profit off of this heavily trending market. And I know this might sound a little bit confusing at first, how does this connect to what I'm talking about in this video? But I assure you it's very important to understand this. So let's say that hedge fund A decides to have this strategy where they focus on a purely buy-focused strategy, meaning that regardless of what happens in the market, they decide that they only want to be buying in the market, so they just keep buying with all their capital every, let's say, month. And through this, they actually end up profiting off of the entire move up in the stock market. So they end up seeing, let's just say as an example, 20% gains throughout this period in the stock market. However, next we have hedge fund B. Again, remember these are competitors that you are competing against when you're trading. Hedge fund B decides to have a strategy where they buy and then sell very quickly in order to secure their profits and have lower risk exposure in the markets. Now, if we look at hedge fund B, they decide to buy at this level and then sell at this level for a 5% profit. And then they make another trade, again, just random examples here, where they trade this and they end up making 5% profit. And in total, throughout this period, hedge fund B, with a more conservative strategy where they're trying to buy and sell and they're trying to predict these downturns, they end up with a 10% profit on the markets. So now you need to think about, well, who's going to be your larger competitor in this example? In a heavily trending market, there will be strategies that will be much more successful than other strategies. And in this specific example of this heavily uptrending market, the strategy that was more successful were the people that had a bullish bias on their trades. So hedge fund A is going to end up being the winner throughout this period, and they are thus going to get more capital to manage. They're going to be your larger competitor in the market because they have been more profitable, and investors are always looking for the highest return investment generally. Obviously, some investors are going to stay with hedge fund B, so now you have hedge fund B with $1 billion and hedge fund A with $50 billion because hedge fund A has been much more successful throughout this period. So now what I want you to look at is the allocation of capital once we move into a bearish period. And I think this recent period in the stock market is a great example of this because it highlights exactly what I'm trying to get across in this video. Although we saw this amazing, absolutely horrible event across the entire world, it's affecting literally every single country and destroying entire economies and markets. If you look at the US stock market, you'd be surprised to see that it is honestly almost at all-time highs. It is only around, let's see right now, 14% from the all-time high in the US economy. I mean, if you look at the economy right now from, let's say, 14% ago, so this was only, let's say, this is around 100 days ago. If you look at the economy now and from 100 days ago, it is such a stark contrast. However, for whatever reason, the market is still continuing to move up, even in this humongous bearish period. And there's a very clear reason for that. Let's go back to hedge fund A and B. Again, who has more capital in this situation? Well, hedge fund A does. And do you think hedge fund A is going to completely redesign everything that they're doing just for this one dip in the market? No. So what ends up happening is you have hedge fund B, and hedge fund B decides, okay, we finally got our lucky start. They finally hit that amazing mark where they're able to short the market for $1 billion with all of their capital, and they end up making some money because the market moved down. However, again, they only have $1 billion to trade with. However, then hedge fund B comes in, or hedge fund A comes in, and they take their $50 billion and they continue to buy the market. So it's very clear here who is going to end up winning. Although we have this absolutely dramatic black swan event that's affecting the entire global economy, the reality of the situation is that the allocation of capital from this long-term uptrend in the stock market makes it so that it is still bull biased. There is still a heavy bias that it will continue to move up. And so this brings me to one of my most important concepts of this entire video, and that is understanding market cycles and allocation of capital. And for this example, I want to use Bitcoin as an example. So let's say that this arrow right here is the chart of Bitcoin. As if you've been trading Bitcoin, you probably saw this exponential growth that we saw throughout, let's say 2017, whenever it went up to $20,000, all the way from, let's say, $1,000, although obviously it started much lower, but let's just use this as an example. So at the beginning of a market that is going into an uptrend, you'll see an allocation of capital that is relatively 50-50 when it comes to bulls and bears. So you have 50% of people at $1,000 when Bitcoin was at $1,000 who think that it's going to continue to move down, and 50% of people who think that it's going to continue to move up. However, what ends up happening is the farther and farther that it moves up, so let's say it then moves up to this price right here, these 50% of people that were shorting the market, they end up getting absolutely destroyed, right? So the amount of capital that's going to be shorting the market ends up getting destroyed. And at this level right here, there is now going to be 80% of capital that is left that is bullish because these people have been making money and they're telling their friends and everyone's buying in, right? 80% of people that are long and 20% of people that are now short. Maybe this is educated investors, maybe these are hedge funds for whatever reason, but at the end of the day, a majority of people, which are the people that are actually moving the market, it doesn't matter if there's some bad news in the global economy, as we've seen with coronavirus, it doesn't matter if there's some technical analysis pattern, if a majority of people still think that the market's going to continue to move up, then it will continue to move up. And the farther that it moves up, the greater and greater this difference will become. So let's say at $20,000, there is a 99% of the market that is bullish and 1% of the market that is bearish. Now you might be wondering, well, if what you're saying is true, if the allocation of capital as a market continues within a specific trend becomes more and more biased towards the specific trend, then how does it ever end up going down, right? And that's why we see this period in Bitcoin where we see exponential growth, and that's what we saw with a bubble forming. However, what ends up happening is now that a majority of the market views the position one way, so we have 99% of the market that thinks it's going to continue to move up, the only way that the market will now move down is with a massive change in sentiment of these 99% of traders. So these people that are holding long positions, the only way that's going to move the market down is if these 99% of people all for some reason come to the agreement that now the market is going to move down and there's some people that are scared in the market, etc. And that's what causes a massive collapse after a bubble. So this is exactly what is happening in the stock market right now. I know it might seem a little bit confusing, but again, this connects to every single trending market. As the market continues to uptrend, there is a higher and higher chance that it will continue to move in that specific direction until there is a massive change in sentiment that will then cause it to collapse in the opposite direction of the trend. So right now, even though there's coronavirus across the entire world, we are still technically in a bullish trend on the stock market. And personally, I think we are still bullish until every single person, this $50 billion worth of funds, decides that they're now scared, that there's a massive change in sentiment, and then it starts moving down. So let me give you a few examples of real world trades that I've been making with this knowledge and with this understanding of the markets. And the first one is a hype stock. Maybe this is not the most high quality trade that you could make. However, I think this is a really good example of it. So if we look at Moderna, which is a stock that's been going up because of coronavirus vaccine research, it experiences pretty much everything that I was talking about in a heavily uptrending market. Here we have massive bullish sentiment because if you go on a website that I love to look at, which is stocktwits.com, which is basically a social media for trading, then you can see that a majority of people on this website, which I really like to look at, a majority of people on this website think that Moderna will continue to move up. So this is a great way for me to gauge that a majority of people, even at this level, think that the market's still going to move up. And that means that there is a bias of capital. So let's just say 80% of capital thinks that it's going to continue to move up, and 20% of capital thinks it's going to move down. So although it looks like it's overextended, and although people will say, well, I'm not going to touch this stock, to me, I see this as an opportunity for amazing upside. And this is what I want to change your mind on. This is not a horrible opportunity where you've missed everything and the market's already made its move and you missed out and you can't profit off of this. I would say that right now, even in a market like this that looks super overextended, it could still be profitable to trade. And that's because you can have huge upside potential and huge risk reward potential when trading these markets. If you look at this specific trend, it's extremely easy to tell when it is invalid. If we just draw this trend line right here, you can see that this is a potential loss of around, let's say 5 or 6%, where this trade would be invalid. However, the potential upside for this trade could be 30% if it goes back to its high, and it could be even higher if it continues to move up in this aggressive uptrend. So you shouldn't be ignoring these markets that are heavily trending. You should instead look at them as opportunities for you to take advantage of a market that is heavily in your favor. Again, 80% of people think that it's going to continue to move up, while 20% of people think it's going to go down. So until the sentiment changes, as long as you use tight stop losses, good risk management, etc., you will be able to have huge potential upside with little potential downside if you trade trending markets in the correct way. Anyways, thank you all so much for watching this video. Hopefully you learned something. Make sure to subscribe, and of course, I'll see you in the next one.